Let's get to Aaron Smith, who's the Managing Director at Pecora Capital. Aaron, give us a view as to how the market is likely to react to what seems to be a potential LDP win, because it feels as though the market's been pricing this in for the last week or two.
Well, Karen, I think you're right. I think the market has priced this in. We've seen that in the Nikkei with a strong upsurge. We've seen the yen weakening in sessions this week. We expect that the yen will continue to weaken, especially if Abe is able to get 320 seats in the lower house. That will give him sort of a veto-proof mandate to print money in Japan. So we believe that this can cause essentially a major inflationary event. Abe himself has talked about targeting 2% in Japan, which would be unprecedented, obviously. And so we see that the yen, certainly at critical levels, testing the March highs from earlier this year. And when it breaks through the 84, 85, we see the yen probably weakening to as low as 100 within 6 months.
Aaron, the LDP was in power for about 25 years, and this is why we saw a change in power last time round to the LPJ. There was a feeling that there needed to be fresh leadership to really shake the Japanese economy out of the sluggishness that's gone on for more than a decade. So what's the LDP going to do around this time round that's going to be so different? Do you think they've learned the lessons of the past?
Well, I think that the first thing is printing money. I think that's the mandate, working towards inflation. The political mandate, the fiscal environment, all point towards a weakening yen. So I think that's job number one. The Japanese trade has collapsed, absolutely collapsed in the past 2 years. They absolutely must weaken the yen in order to get any sort of recovery in the Japanese economy. Some of the most important manufacturers in Japan stand to be downgraded. I'm really not sure what, if anything, the political situation is going to do about that. The economic prognosis in Japan is dire, and the long-term outlook would be quite poor. Naturally, we expect the equity markets can perform well in the short term on a bit of a sugar high from weakening yen.
Yeah, and that's the point I wanted to make, Aaron, that because of the Japan's export, or the Japanese economy's export orientation, every time this yen falls, there'll be a constituency that says, just load me up on more Nikkei, I'll take some more topics. Even if the story remains weak for the economy for most of the year, you're actually going to make money in Japanese equities, aren't you, as long as the yen continues to weaken?
I think you're absolutely right. We will see, and we have seen, a divergence between the economic activity and the performance in the equity market. The question that you have to ask yourself as an investor is, when will the penny drop? So that's a very precarious situation to be bidding up equity markets which have no rational basis for bidding up higher, except for the fact that interest rates are zero and the yen is weakening. So rather, a more intelligent way to play that trade is, and probably a cheaper and more efficient way to play that trade, is simply by having a basket of currencies which would be long vis-a-vis the yen. That's how we're positioned today at Pecora. We're long pound sterling, euro, Aussie dollar, US dollar, all versus the Japanese yen. And I suspect that 2013 will prove to be an excellent carry trade for yen in gold. So sell yen, buy gold, and I think that is going to be one of the dominant themes for the coming year.
Aaron, let me just beg to differ for a moment. The implication in your question is that there is something that appears on the horizon that is a surprise about the state of the Japanese economy. But this is a market that's still, at 87% below its all-time high, albeit a different index, but that's worth bearing in mind. And we've had, nearly 3 decades to understand what's wrong with the Japanese economy. Where's the surprise?
Well, look, I think that the Japanese equity market has obviously performed extremely poorly over a long period of time. That disproves a lot of the long equity thinking that you hear in classical circles. I think we really have to take a step back and sort of question conventional asset allocation models that are being sold to private investors and institutions worldwide. Frankly, we don't know what the impetus will be in Japan. That's why we have a systematic approach, and that we can look at the technicals in the market and react very quickly using models that follow the markets. I think that's probably better than guessing what the impetus could be. That being said, we're in an interest rate zero world. Japan's been that way for a long, long time. The central banks are sort of pulling at a rubber band, which is a very, very powerful rubber band, but eventually that band is going to snap. Now, what will trigger that snap is hard to discern, but when it happens, our systems have to be prepared to react because it'll be such a violent and fast swing that JGB will crash, equities will crash, and the yen will weaken tremendously, but in a very, very short and violent action.
Yeah, I just want to delve into that a little bit further, because that's something we've also been noting here in our discussions on Japan, that there are so many hedge funds out there, and you also now point out pension funds as well, that are getting to the point where they're starting to short JGBs, that the one-way trade might be starting to end. But we know a lot of Japanese corporates like to reinvest in this market to keep the cash onshore, I guess, for dividend payouts and other reasons, that pension contributions. So what is actually going to cause that trigger? That doesn't, I mean, what you mentioned about market dynamics doesn't seem to sort of conquer that main element where the Japanese corporates need to keep the money onshore.
Well, I think the biggest trigger, Karen, will come not from Japan. We're in a global financial system, and we're in a zero interest rate environment worldwide. The central banks have conspired to create that environment. We'll remain in that environment as long as the central banks control the fiscal situation, the monetary situation. That won't last forever. Eventually, the market will prevail. People will start to demand higher rates of interest, reasonable rates of interest. We cannot sit in a negative real rate of return environment forever. It's crushing the middle class. It's crushing pensioners, retirees. It is only benefiting large corporations and ultra-high net worth individuals who can borrow. So this zero interest rate environment is not helping small businesses. It's not helping entrepreneurs. They can't borrow money. If you try as a small business to borrow money, you're going to pay usury rates if you can find a bank to lend to you. Certainly we think that eventually interest rates will snap, and that will JGB will not be will be part of that picture. There are a lot of hedge funds which are already positioned that way. I think that there are even more who have orders in the market ready for that action to happen, because a lot of people have been wiped out trying to short JGB over the years. What we think would be a more intelligent thing is, instead of looking for a price level from a quantitative standpoint, we're looking for a certain type of price action. We're looking for a spike in volume, and we're looking for a big velocity, and that will give us the entry point to short JGB. But again, as I'm saying, we're already short yen, and we think that that is probably the safest and easiest way to play this trade.
Yeah.
We've seen a beautiful move, very clear move in the yen this week. We expect that to continue through the election, especially if 320 seats are taken.
Okay, thank you so much for setting up the election for us and giving us a view of what to trade. On the back of it, Aaron Smith, the Managing Director at Pecora Capital.